your credit score and how to improve one. This is Robert Niyazov, your trusted mortgage source. Please watch this video until the end because there's a lot of useful information we're going to cover today. And we are starting. Let's first deep into how the credit history in the US is reported, and most importantly, how is it collected. So there are three what we call credit bureaus, and they're called TransUnion, Equifax, and Experian. Those are major companies. They're presented on a stock exchange. They've been around for a long time, and they what they do, they supply the public and institutions with credit scores. We're going to talk about individuals today, how their score is determined by these companies, and what we can do to improve it, and how it actually has an application in your life. So let's start with the credit score range. Usually it is anywhere between 400 to 850, and something like 760 and above considered to be excellent. Anywhere between 700 to 750 is considered to be good, and anywhere between 660 to 699 is already satisfactory or fair, and then below 660 is is obviously a low credit score. So that's just a general idea. Now, next thing is how that score is used. Anyone who wants to give a credit, let's just say you want to apply for auto loan, or you want to apply for a mortgage, or even for a credit card, the issuer bank will say, okay, let's take a look at what this individual's credit score is. And this is why it's important to have it as high as possible. So for example, why in general use a credit card? Why? And interestingly enough, those who don't have any credit cards or have any credit, obviously, they cannot have any credit score. So that's also not so good. You cannot get any new credit. But suppose you have a credit card and you just decide not to use it. That's also not the best thing, because bank wants to know that you use the credit card, you make purchases, and you pay on time. That's what they want to establish. That if somebody gives you credit, you can pay and pay on time. That's the main thing about the credit. There are other components, we'll cover them later in this video. Now we're going to talk about what this credit score, what effect does it actually have on the consumer. And I'll give you an example. It's the best way to just to show it with the example. Consider two absolutely, same financial individuals. They have the same kind of salary, they have same kind of experience, and one has a credit score of, let's say, 600, which is bad, and the other one is a 720, and they both shopping for the same car, okay, or for the same mortgage. So it ranges from not obtaining that credit, okay, to maybe getting the credit for the one with the bad credit score, with the higher interest rates, and maybe with more down payment. Let's just say the going rate for a car finance is 7%. And that's like with the good credit history, someone with good credit score. So that person will get 7% with as little paperwork as possible. Now compare it to the one who has 600 credit score. First, the bank will require more paperwork, and they will charge him 11, 12, 13, sometimes 18%, just because the credit score is low. So this is how important the credit rating is in the United States. Now we're going to talk about what affects the credit scores, what affects the credit rating, okay? So there are several factors. The companies that I mentioned before, they all build their own models, okay? They basically, I'm going to list the factors first, the main factors. Factors such as payment history and the length of your credit cards, your payment ability, and utilization. So what utilization is, just so you know, it's the percentage of the credit limit used. For example, if the credit card has a limit of 5,000 and you actually made a purchase for 4,000, so utilization is 4,000 over 5,000. In this case, it's going to be 80%. But let's break it down a little bit more, about each one of them. So first is, of course, the payment history. This factor has the biggest weight in most credit scoring models. Sometimes it's 40 or even above 40% of your total score. That's how they come up with the score. So you see, the companies, they need to come up with a score, and they say, okay, it's almost like in the exam in college. 40% final, 30% for midterm, etc., 10% homework. Same thing here. They will take, let's say, 40% for your payment history. The second one is the length of your credit history. So this is a very interesting moment. I want to spend a little bit time here. This is how fresh or not your credit history is. In other words, you only have 2 credit cards that you opened 1 year ago, okay? Compared to the same situation, but the person had credit cards for 5 or 6 years, everything else being the same, the one with the 5 or 6 years credit card will have a better credit score because the credit history is longer. And to that extent, I want to give you an example of my personal example. Many people, including me, when they open a credit card, they have it for, let's say, 6, 7, 8 months, sometimes a year or 2. Then they open the second one and they think, okay, it's time to close the first one. And they do that. And what happens? Now the credit history, these 2 years that they were building it, all of a sudden is shut. You see, the computers cannot count this anymore because that card is closed. So if you open a credit card, do not close it. Keep it open, especially the one that is open for longer, because the length of your credit history will be counted from your first credit card. Okay? That was the second factor. The third factor is the utilization that we touched before. Try to be below 30%, meaning if your credit limit is 10,000, do not have your credit card balance more than 3,000. You can, it's okay, but your credit score will go down because of this. If you want to improve it, it has to be below. The next one is, to me, is a very interesting factor that they also use in their models when they create a credit rating, is the mix of your different types of credit. So it could be credit cards, it could be auto loans, it could be installment loans. Let's say you just take money, you borrow money to buy an equipment, mortgages, student loans, etc. When you have a better mix of those credit lines, you get a better credit score. It's not a very heavy factor, but it is a factor nevertheless. Now we're going to talk about our next topic. Now, how do we take advantage of all of this? How do we make sure that our credit score is good or can be improved? So we can go through those items again. So payment history. Please make sure you make payments on time. Even if your credit card is due on the 18th of the month, for example, do not miss it. Do not go to the 28th or even 21st. Make sure you pay it by the 18th, that they receive it by the 18th. Show them that you're responsible. And if you don't have all the money to pay it off, pay the minimum. Minimum, if you pay the minimum, is better than, paying more later. I've seen this, okay, let me save up a little bit more and I'm just going to give more to the credit card company. I've seen some of my clients do this. Not a right approach. Pay the minimum, but pay on time. If you can pay more than the minimum, even better. Second, I was talking about the length. I already told you, please do not close the old cards. And if you're just starting and you want to, but you only have one credit card that's, let's say, 1 year old, or you don't have any credit cards yet, you can ask one of your family members, somebody close to you to actually help you out, they can open a card on your behalf. It's called an authorized user. And if they have that card for a long period of time, let's say for 10 years, all of a sudden the computer counts that your history is 10 years old because you will be added to that card. Just make sure that they do not do you a disservice. They do not connect you to the card that was late, because that's going to only negatively affect your credit. It will do something good with bad. One other factor is if you check your credit too often, okay, that also may drag your credit score down. Now, don't be scared. If you need to shop, let's say, for a best credit card, you can check in one or two places. That's okay. What they really want to prevent that you are checking it, 10 times, in a short period of time, let's say in 2 weeks. They're really thinking that you cannot get credit. That's again, the bureaus think, okay, this person cannot get a credit or is looking for so much credit. Maybe he's in financial predicament, and that's why they will lower your credit score. And next, we already talked, I think that's the easiest thing to do when you need to a quick credit fix is to pay your credit card balances down so they're at not as much as 30%, so it's 30% or less. That will also boost your credit report. Now, you see, let's talk about this topic a little bit longer, because when you pay the credit card down, let me give you an example. Let's say you have a credit card with $10,000 credit limit, okay? But you owe $7,500 on it, okay? And now you want to apply for a mortgage and your credit score is 660. If the same situation, but your credit score was 710, okay? 50 basis points, or we will have 50 units higher, then the ability for you to get a mortgage improves, and you get a better rate on your mortgage. So that's how important it is. So what do? We can pay down that credit card with a balance to less than 30%, but it takes time for the agencies to update this. It takes about 3-4 weeks. In a place like here, we have the ability to improve your credit score within days. It's something that we have as mortgage professionals. We have an agreement with the credit report providers that they can accommodate our clients. In closing, please feel free to ask us a question. You can also leave a comment here, subscribe to our channel, like this video, suggest more content. We'll be happy to prepare and continue educating the public. And remember, in our company, in our mortgage company, at R&J, we always find a way. Good luck, everyone.